Hello, my name's Tom Pallow. I'm the inventor and the primary designer of the Qualified Business Income Deduction of the Tax Cuts and Jobs Act of 2017, along with two very other important tax reforms you may already know about. Now, I've worked on these tax reforms for over 30 years, and all of these tax reforms are designed to raise government tax revenues without raising overall taxes. Very importantly, all three of these tax reforms are designed so that they can be enacted in Republican conservative ways, as the Qualified Business Income Deduction was with the TCJA of 2017. Or these tax reforms can be enacted in statically scored bipartisan ways. Link to this video, you can watch Senator Susan Collins discuss the Qualified Business Income Deduction in a much more bipartisan way that she originally co-sponsored with Claire McCaskill back in almost 10 years ago. So that I have that link to this video. But very importantly, in this video, what I want to do is go over the much more progressive ways that all three of my tax reforms can be enacted. The more progressive and bipartisan ways. That's what we're going to really get into this video. And you're going to see how, given the global economy that we're now in, of the 21st century, that this is how to reform most of our tax code. So anyway, let's get into it. Now, before I get into how to make the Qualified Business Income Deduction much more progressive or bipartisan, along with my two other tax reforms, I want to get into why we need to do this at this point in our history. Why is it so important? Fundamentally, there are three reasons. One is we haven't changed our tax code fundamentally in over 100 years. Number two is we need revenue. We have a worse debt to GDP right now than we did right after World War II, after a major war. The third reason, and probably the biggest reason, is we've had a six-fold increase in economic competition since the late 1960s. Six-fold increase for the United States in economic competition since the 1960s. This is true for most of the countries of the world. They've gone through the same competitive pressures, and we're going to go through some of this data. Now, competition necessitates the creation of new efficiencies. This is true with individual humans, groups of people, and nations. So going back to a little bit of the history, in the early 1960s, the Soviet communist economy was sputtering and it was slowing. And they tried some reforms, and those reforms failed. And President Kennedy brilliantly saw this. He took notice of this. It was very important to him. And what he did was he decided to double down on the General Agreement on Trades and Tariffs, on GATT. GATT had been around since World War II, but John Kennedy decided this was how we were going to win the Cold War. We were going to win it as an economic war. We were going to reach out to our trading partners in Europe and Asia and the underdeveloped world and build their economy. So we opened up our economies more than we ever had to the developed world, the developing world during this period. We had the Kennedy round of GATT actually ended in 1967, and then we had another round of GATT in 73, and in 85, the World Trade Organization started in 1995. And during this period, the Soviet Union was weakening. We were building our economic coalition with the developing world. And as the Soviet Union weakened and it finally fell, what it did is it opened up a cheap labor market of 4 billion people to the 2 billion people in the developed world. So there are the developed world, 2 billion people. Prior to the fall of the Soviet Union, if an American multinational corporation or European multinational corporation wanted to invest in the developing world, they always had the fear that business, that capital investment could be nationalized by an emerging communist government that was being subsidized by the Soviet Union, and their entire investment would disappear. So when the communist Soviet Union finally collapsed, this opened up a cheap labor market of 4 billion people to the 2 billion in the developed world. And since then, we've had a 6-fold increase in economic competition. And let me go through some of these numbers right here. And again, this is why it's so important for us to reform our taxes. Let's go over some of these numbers here. In 1965, U.S. imports only constituted about 4.3% of U.S. GDP, and U.S. exports constituted only about 4.8% of U.S. GDP. Now, by 2018, U.S. imports had gone up to 15.3% of U.S. GDP, and U.S. exports were 12.2% of U.S. GDP. Now, 2018 wasn't even our peak year for imports and exports either. Now, if we average imports and exports over those 2 years, what we get is an over 300% increase in foreign economic competition for the U.S. since 1965. But that only tells half of the story, because in 1965, 2/3 of what we trade is manufacturing and industrial services. In 1965, that constituted 36% of GDP. Today, it's still about 2/3 of what we trade, but today that's less than 18% of U.S. GDP. What does that mean? That means per unit of GDP, the U.S. manufacturers, industrial service providers have to deal with over 6 times the competition. Per unit of GDP, American manufacturers have to deal with over 6 times the competition. That's what those numbers in reality mean. But we're not the only country who's felt those pressures. Most of the rest of the world have felt equal economic pressures since the late 1960s. So if we look at here's a chart here that has throughout the world how foreign trade has increased as a percentage of gross domestic product throughout the world. And with these competitive pressures, what's happened is countries throughout the world have felt the need to reduce taxes on their corporations, on their wealthy and the personal income tax, and on their capital gains to remain competitive, to reduce the foreign outsourcing. So what's happened has been a race to the bottom as far as tax rates throughout the world. We can look over here. You'll see here's a number of our major trading partners and how since the Reagan-Thatcher era around 1980, how personal income taxes have dropped through that period with our major trading partners. Here's another list here with some of our major trading partners, how their corporate tax has decreased since about 1980. Here's another chart, really great, about how corporate taxes have dropped drastically throughout the world since about 1980. Now, and here's a bit on our some of our major trading partners and how the capital gains taxes have decreased also since about 1980. And what this means is, of course, obviously most nations throughout the world have continued to spend at the same rates. And what has happened is we've only relied on monetary policy, and not at all on fiscal policy. And what's happened is we, at the same time, acquired record debt throughout the world, not just in the United States, but with most of our major trading partners and throughout the world, government debt has increased. So let's look at some of those numbers and the outcome there. So as foreign economic competition has exploded throughout the world, and as governments throughout the world have been reluctant to raise taxes on their wealthy and corporations in order to remain economically competitive over the last 40 and 50 years, what's happened is record government debt has accumulated. This is true for the U.S. and most of the major economies of the world. You can look here on this chart, you'll see some of this right here. And with this government debt, even as economies have slowed, the reluctance to raise taxes on wealthy and corporations has caused governments throughout the world to rely on lowering of interest rates, on monetary policy to stimulate the economy. And after 30, 40 years of this, what's happened is interest rates have gotten so low. Even 20 years ago, they were nearly zero. And in 2008, we had to rely on new and strange ways of quantitative easing to stimulate the economy, and these are risky. They're kind of sketchy, these new ways of quantitative easing. And with interest rates essentially close to zero, now we do have to finally rely on government spending on fiscal policy to stimulate the economy. But we need to pay for that. And we have these global economic pressures. So that's why these tax reforms are so important. That's why the Qualified Business Income Deduction is so important. Personal income taxes are 45% of federal revenue. FICA taxes are about 35%. Corporate taxes and investment income taxes are about 10%. And estate taxes and tariffs constitute about 5%. However, personal income taxes constitute 75% of the progressive tax base. That means progressive tax is a tax that mostly the wealthy, high-income earners pay. So by reforming our personal income tax, we're reforming 75% of our progressive tax base. And that's what the Qualified Business Income Deduction does. So anyway, let's get deep into this and see how we can make our tax code much more progressive. So the key to understanding how to achieve this is to research deep into the nature of the income and the savings of the economy's highest income earners. So right now there's talk about raising personal income taxes on those who make over $440,000 a year. For this video, I'm going to go into the detail and the nuance of the income of those who make over about $530,000 a year. That's where the top 1% of U.S. income earners begin. And so that's the most relevant data. So that's what I'm going to discuss right now. So very, very importantly, let's go over the three main sources of income of the top 1%. About 15% of all the income that's produced by the top 1% of U.S. income earners is the profits of any private company that's taxes personal income that has one or more employees in the U.S. Just 15%. Now, 25% of the income of the top 1% of income earners in the U.S. is our income from people who work for others, who are employed. These tend to be high-priced doctors or lawyers or technical people who work in the tech field and work for big corporations or big law firms. And the remaining 60% of income of the top 1% is some form of investment income. Now, these three sources of income, the most important point I'm making here is their effect on the economy, on growth, economic multiplier effect, all of that are fundamentally different. They are almost polar opposites. So the 15% is responsible for much growth, and the other 85%, very little. And so let's discuss that nuance and the importance of that. So this 15% of income of the top 1% of income earners in the U.S. that is derived from U.S. employers. Their income and their savings as well tends to have a much, much greater effect on economic growth than the 85% of income and savings that come from the rest of the pie of the top 1% of income earners. And this is for several primary reasons. The first is these job creators in the U.S. that are in the top 1% of U.S. income earners and are taxed as personal income, these are generally the most successful, fastest growing businesses, fastest growing job creators in the country, and some of the highest paying. This is because our economy tends to bubble up from the bottom with new products and services and business models. And typically, businesses like this that are taxed as personal income are responsible for 55% to as much as 90% of all new private sector jobs. Now, this number lately has been around the mid-50s. It's been lower than it's been generally over the past decades. To me, in my opinion, that's because a lot of businesses that would be private businesses right now that taxes personal income in the tech field have been bought out and absorbed by some of our tech monopolies. And so this has skewed the numbers a bit. Nonetheless, this 15%, they are the most successful, fastest growing job creators in the country. All right. Now, the other 85% of that income, 60% of it is just going to become consumer spending, and 40% of that will go into savings. Okay. Now, very importantly, I'm going to cover this later because the next section we're going to talk about is how to reform the investment income tax and make it more progressive while raising more revenue and contour to the global economy. But when we go into that, we'll see that 95% of that 40% of savings that the other 85% of income saves, 95% of that never sees the real economy. It tends to be just existing stocks and bonds or derivatives that are bought and sold between existing wealthy people. It never actually gets into the real economy. And we're going to fix that in the next segment. But the important point here, the second very important point is that for these private businesses that are taxed as personal income, that are in the top 1%, this is a very important point, their investment opportunity in their business is much, much greater and much, much higher. They're the most successful business in the country. Taking their savings and investing in their business will have a much higher rate of return generally than putting it into regular savings, into your typical IRA, into your typical investment fund somewhere. Much higher greater rate of return, and they have more control over it as well. So what their savings, instead of being 40%, first of all, much more their spending tends to be in their business. There's much more of the saving tends to be in their business as opposed to just consumer spending. And here's the third very, very important point. That spending that tends to go much more in their business, and that savings that tends to go much more in their business will much more often reach an employer as wages that then become spent again in the economy, and perhaps even again in the economy. The multiplier effect is much more than than the 85% of that top 1%, that 60% that goes in just regular consumer spending. It does have a multiplier effect, but not as much as going into wages as well. And then the other 40% is just going into savings. 95% of it doesn't see the real economy. It's just paper trades, and we'll cover that. So in the end, this is how qualified business income deduction can actually raise tax revenues without raising overall taxes. Because if we shift the tax burden off of the 15% that are employers, and we statically scored, as Collins McCaskill S1960 did way back in, in 2011, 12, and 13. If we lower the taxes on the 15% and raise taxes on the 85%, because the 15% is much more spent throughout the economy, and the 85% is not, even though we've equally made a shift, we haven't raised overall taxes. We've just lowered one rate, and we lowered the rate on the employers. We equally raised the rate on the non-employers, the 85%. And since 85 is so much greater than 15, statically scored, the 15 will go into the economy much more, and the 85%ers will see very little, sees the economy. And because of this net extra growth, we come away with more tax revenue without ever raising overall taxes. So to summarize here, private U.S. employers who are taxed as personal income and who are also in the top 1% of U.S. income earners, these are America's fastest growing job creators and most successful businesses, and really the economy of the future in America. And for this reason, they're spending and their savings both have a very disproportionately high positive effect on economic growth when compared to the 85% of other income within the top 1%. So much so that if we were to cut taxes on the employers by, say, 20% and then raise taxes on the 85% of non-employer income by 4.6%. So it was a statically scored trade-off where we're lowering taxes on the employers and raising them on the non-employers in an equal amount so that technically we were not actually raising taxes. We would actually come away with much more tax revenue. That's because we've made the economy more efficient and we've helped to incentivize monies to go in much more efficient places. This is so much true that, say, if we were to raise taxes on the non-employer income by much more than 4.6%, we would raise even more tax revenue, and we would create the greater difference we made in effective tax rate between the employer being lower and the non-employer income being higher, the greater we would create an incentive for America's wealthiest to create jobs in America. So, for example, the Congressional Budget Office estimates that for every dollar of taxes that are raised on the wealthiest, only about 80 cents comes back in. And this is on the personal income tax increases. And the reason being, a lot of that reason is the disproportionate amount of money that is now taken away from America's fastest growing job creators. So that shortfall of 20%, a lot of it is because with tax increases that do go on employers, their capital for expansion is being taken away from them. So that expansion doesn't exist. So by having the qualified business income deduction, we're solving this problem. And we're actually creating an incentive to employ in the U.S. while raising more revenue at the same time. So one of the two ways that you can make the qualified business income deduction more progressive is obviously to raise taxes much more on the 85% of income in the top 1% that is non-employer income, all right, while maintaining all the qualified business income deduction for the 15% that are employers. Now, in the next section of this video, I'm going to go into how to reform our investment income tax and make it adjusted to the global economy while raising much more revenue at the same time. In this third section of this video, I'm going to go into how to reform our C corporation tax. When I do that, I'm going to explain a second way to make the qualified business income deduction in our personal income tax much more progressive way, an entirely different way, and I'll get to that in the third section of this video. But next up, again, 75% of our progressive tax base is personal income taxes. About 17% of our progressive tax base comes from investment income taxes, and about 8% comes from estate taxes. So these are our three forms of taxes that primarily the wealthy pay, right? So if we're going to make our economy more egalitarian, which is our goal here, to make it egalitarian and prosperous simultaneously, more so on both ends, then we need to reform our progressive tax base. And next, I'm going to get into how to do that with our investment income taxes. So let's get into that. So about a month ago, the Senate Finance Committee had a hearing regarding tax policy and tax reform. And one of the things that both parties completely agreed upon in this hearing is that we need to do whatever we could to create a tax policy that brought our supply chain home, our manufacturing supply chain home. We need to do this for economic reasons, for safety reasons regarding the military, and for safety reasons regarding health. COVID proved that, right? So I will say this, no tax reform will do more to bring our supply chain home, our manufacturing supply chain home, than this particular investment income tax reform. It will modernize our tax policy in regard to the global economy by greatly incentivizing business and capital investments here in the U.S. while raising much, much, much better tax revenue, if possible, if desired. So anyway, the key to understanding this tax reform is to understanding the mechanics of the financial markets, how they actually work, okay? Most importantly in this regard, understanding the specific financial investments that will have some of the monies that go into that investment go into direct capital, business, and jobs in the U.S. Those monies and that investment will find their way, most of it, into the direct U.S. economy as jobs and business capital investments. Those investments versus the investments where that's not going to be the case at all. Perhaps on some consumer spending, and will it have a bit of a multiplier effect, but virtually all of it's just paper trades. So we're going to go into the difference between those two investments. And obviously what we want to do is lower the taxes on capital gains, investment income that come from the first group, that is direct investments in the U.S., and raise, if desired, taxes on investments that come from the second group. Now, fortunately, the first group is about 5% of all capital gains, around that virtually all the time, around that group, around 5% of all capital gains. So the math on this tax reform works really, really well. And so let's get in. So this first group of financial investments that will have a lower tax rate for gains that are derived from the financial investments. These are essentially 4 special financial investments, and they are the vehicles that are used by businesses to raise capital in the stock market, in the financial markets, to expand. All right. Now, also with this tax reform, there is going to be accompanying and needed U.S. wage and capital expense requirements. They're tagged to these investments, and I'll go into a bit further how to do that. My website will cover this. Oh, it covers this a lot. But essentially, these are the 4 financial vehicles that will receive a lower tax rate, again, with the proper amount of accompanying U.S. labor expenses that go with them. One is, first of all, large corporations tend to float bonds to expand and raise capital. So the first financial vehicle that would have a lower tax rate with the proper accompanying U.S. employee expenses would be bonds that are bought at first issue by a U.S. corporation or a U.S. corporate subsidiary of a foreign business. That would be the first category. The second is U.S. corporate or private entity stock that is publicly traded, but bought only at first issue of that stock, be it at an IPO or a secondary issue of stock. Okay, so when the stock is first issued, right? The second of the 4 special financial investments are any U.S. venture capital investments that are made through established banks or venture capital banks, right? Venture capital firms. And again, these are going to all need acquire the proper amount of accompanying U.S. labor and capital expenses for the investment to have a lower tax rate. And then the 4th vehicle is the financial underwriting of any of the above financial vehicles that I just said, the 3 that I just said. So anyway, gains from those 4 investments only constitute about 5% of all capital gains, right? But they do they have a huge multiplier effect because, again, I'll go into a little bit of how you tag accompanying labor and capital expense requirements in the U.S., and my website's going to cover that a bit. But the other 95% of financial market gains. These are what, back in the day, well, I'm an old man, they were once called paper trades. Often it was called the secondary market. Today we know it as the derivatives market. It's an existing stock. 95% of the time, there's an existing bond or stock. A lot of people invest in commodities derivatives, and all that's being traded is an existing stock that's being sold to someone else for money. And all that's being traded is the ownership of the stock, or the ownership of the bond, or the ownership, or a chance much later in the future possibly to buy a commodity. But these monies, 95% of the time, it almost never sees the economy. It's just, again, within the top 1%, 60% of that income is savings, and these are just paper trades back and forth between wealthy people, and they rarely make it to the actual economy, whereas this 5%, especially tagged the way we're going to do this, there's a huge multiplier effect on the economy, amazing growth. So let's cover this a little bit more. So to clarify here with this tax reform, the lower tax rate on gains can only be given at bonds bought at first issue or stocks bought at initial public offering or secondary offering, or with U.S. venture capital, or the direct underwriting of these three investments. Therefore, once a stock cannot be sold a second time, or a bond cannot be sold a second time and still have a lower tax rate. This is only at the capital formation stage that we're trying to give a lower tax rate. This is in an effort to, one, pinpoint direct investments in the U.S., and also to lower the cost of capital for businesses in the U.S. So, and also very importantly, a lower tax rate cannot be given unless there is accompanying an adequate amount of U.S. labor expenses that are tagged to each investment. Now, on my website, I go into much more detail of how this is done. This is a hard thing to do on video. It is an area that's much better done on paper, where you can really look things over and read it over. So go to my website. It's one word, thirdwaveprogressives.org or qualityism.org. Either way, you'll find it, and you'll get into the real details of this particular tax reform, along with my other tax reforms. But again, importantly here, the outcome is amazing with this tax reform. So let's go over some of the great benefits of this tax reform. So the positive effects of this tax reform are many. For one, this tax reform would greatly reduce the cost of capital for expanding businesses in the United States. It would do this by pinpointing and incentivizing investment at the time of capital formation, when stocks and bonds and venture capital is being bundled for U.S. expansion. And by incentivizing investment at that point, we would greatly reduce the cost of capital for American businesses, and American business specifically who are expanding in the U.S. So therefore making them more competitive and increasing our economic growth. This tax reform also would have a much greater multiplier effect because, again, it's incentivizing wages and capital expenses in the U.S. and not just paper trades, not just an existing bond, existing stock, so existing equity for money. So just paper trade back and forth between wealthy people typically. This tax reform would also have the effect of reducing the adverse effect of speculative investment bubbles that crash. This would occur because we would be incentivizing the financial markets to invest in the tangible real economy that has a much larger multiplier effect that would therefore be able to weather much more easily a bad stock bubble that broke. because the economy itself would be in a much more stable position. This tax reform would also, it would incentivize investors who research into actual businesses, actual sectors of the economy and the actual economy, as opposed to those investors who spend all their time just researching the speculative movements of the secondary market and the derivative market and the market of existing bonds and stocks that have been sold many times over for years, just paper trades for money between two high-income individuals and wealthy individuals. So this would, again, incentivize research into the real economy. This tax reform could also fix the hedge fund issue. If we were to carve out, while taxing hedge funds, these four specific financial investments with their U.S. wage qualifiers, what we would do is we would incentivize hedge funds not to outsource, and we would also greatly increase our tax revenue, federal tax revenues. One or the other would happen, or likely both. This tax reform involves the most heavily regulated area of the economy. The financial markets are one of the most heavily regulated areas of the economy already. And this tax reform also involves data that is already collected by businesses and the financial markets. So for that reason, it would be very difficult to gain. So last month at the Senate Finance Committee hearing, the representative of the National Association of Manufacturers called a broad-based investment income tax reform like the one I'm presenting here the best thing that could happen to American manufacturers. And that is truly the case. So for the details of this tax reform, and you need much more details, go to my website, thirdwayprogressives.org or qualityism.org, to find the exact definitions of when a stock or bond is bought at first issue or when it is sold for the first time. What are the qualifying labor and capital, U.S. labor and capital expense requirements, and how are those calculated? The specifics of all those things are on my website, and it's just an easier and more appropriate place for that. Also, you can find how small investors can also get into buying these foreign investments as well. So what we've actually done here with these two tax reforms is we've reformed 92% of our progressive tax base. With the top 1% of U.S. income earners, 60% of their income comes from investment income. 40% of their income is saved. So what we're doing here is we're directing, we're incentivizing investments into U.S. jobs where they drive up U.S. wages. Few things do better in increasing U.S. wages than the incentive to hire in the U.S. And that's what we're doing here. We're making the tax code much more progressive by raising much more revenue, but contouring at the same time to our global economy, making it much more competitive, and then again directing these investments in ways that raise U.S. wages. And what could be better? So in any case, let's go on to my corporate income tax plan. My third tax reform is a higher wage tax incentive for corporations and possibly for larger private pass-through businesses within the personal income tax. Simply put, this is the idea of contouring income tax rates such that the better a corporation compensates their employees relative to the national average and their regional average, the lower will be their income tax rate. And the opposite is the higher will be the tax rate for those corporations who do the opposite and compensate their employees the worst. So, for example, what could happen is, suppose with this next round of tax policy legislation, the top corporate tax rate in the U.S. went from 21 to 25% as the top, as an average. However, what we did was America's best employee compensating businesses would have a top tax rate of just 15%, and America's worst employee compensating corporations would have a top tax rate of 35%, with an average of 25. Now, every 10 years, economies have a major economic turndown, and every 5 years, there's a smaller business cycle. And what this means is most businesses within the economy have to readjust their business model in some way to keep up with the times and remain competitive. What this tax policy would do is incentivize entrepreneurs at the point of creating their business model to come up with business models that compensate their employees at much higher levels than the average. And what that, of course, would do is take productivity gains within the economy that are made via technology and other ways. It would take productivity gains in the economy and allow workers to capture much more of that productivity gain as wages for themselves. It would be incentivized in the tax code to do this. So there's great economic benefits for society, for the economy, for our democracy. This tax reform would have amazing benefits. And it's actually relatively simple to do, so let's get into a little bit of that. With this tax reform, it's simply easier for you to go onto my website, thirdwayprogressives.org or qualityism.org. It's the same website. And you will be able to find there the actual details of how to make this tax reform work, the specifics to make it work without it being gamed. But in short, essentially what we could do is the IRS has an average annual wage calculator that it uses for a small business healthcare tax credit. We could use that calculation with just a few minor changes. We could use that to calculate a corporation's average annual level of compensation and have a national ranking and a regional ranking. Those two rankings would be averaged, and then that corporation would be ranked from 1 to 20 or 1 to 10 relative to the rest of the corporations. And then if we're going to reward America's best employee compensating businesses with a 15% tax rate and the worst compensating with the 35, then that rank order of 1 to 10 or 1 to 20 corporation would have a tax rate correspondingly, given how well they ranked among everyone else, between 15% and 35% for their highest income tax rate. So this tax reform would have the effect of raising federal tax revenues without raising overall taxes. It would have that effect. And it would have the effect of moving productivity gains with technology and innovation. Productivity gains in the economy, moving it to employees. It would have both those effects for the same reason, which is it would incentivize at the point of the inception of business model, entrepreneurs to come up with business models that compensated their employees at higher rates. So if we had an average C corporation tax rate of, say, 25%, but our highest compensating C corporations had a tax rate 10% lower, and those between the average and the highest compensating somewhere in between 25 and 15. And then America's worst compensating corporations would have a top statutory rate of 35%. And then those in between the average and the worst compensating businesses would have a top tax rate somewhere in between 25% and 35%. If we did that, we're not actually raising, well, we're raising overall corporate taxes from 21% to 25%. But overall, we'd be creating much more government revenue because we'd be incentivizing higher wages that have a higher multiplier effect in the economy. And the better thing is our higher wages for our American workers. Now, I know that less and less statutory tax rates in the C Corporation tax code mean less and less. There are so many deductions within the C Corporation tax code that effective rates for especially the largest corporations are extremely low and well below the statutory top rate of 21%. Now, the best thing we could do is recalibrate these over time, these credits. And obviously some of the R&D credits and so on we want to keep, but we should recalibrate our credits such that the corporate tax rate actually means something. And if we were to have a credit, or, we obviously R&D credits are important, other credits are important, but the most beneficial credit we could possibly have is a credit for higher compensating businesses. I think this becomes evident because we're pinpointing our desire, our goal, more than anything else, more than any other tax credit, more than R&D tax credits. We're pinpointing our inevitable goal, which is higher wages. So there you have the three tax reforms that I feel are extremely important for us to pass at this time in our history, given the global economy and the six-fold increase in economic competition that has occurred for the U.S. since the mid-1960s. Now, as I've shown in this video, all three of these tax reforms would raise federal tax revenues without raising overall tax rates, or overall taxes, I should say. Also, all three of these tax reforms have the ability of raising much, much more federal tax revenues while simultaneously creating a much more competitive economic environment for all of American businesses, which, again, I showed the six-fold increase in economic competition. So this is so very important at this time in our history for raise our revenue, to do it in this way that, again, is much more efficient and incentivizes U.S. job creation. All three of these tax reforms, of course, would be great for the economy, and for the reasons I've said, they would be very, very politically popular as well. The Qualified Business Income Deduction with a personal income tax increase on the non-employing wealthy is extremely popular, as is the other three tax reforms. This is also very, very important. All three of these tax reforms involve credits for employment and levels of employment, such that we could create great synergy with our trading partners, with our free trading partners throughout the world. Now, earlier in this video, I described how John Kennedy back in the early 1960s realized that the way to win the Cold War was to win it as an economic war, to outproduce the communist Soviet Union. We are now in that same sort of struggle with China, at least just on an economic end. These tax reforms we could use with our free market democratic trading partners to build a coalition. And there's synergies here on these tax credits where we could have an international tax regime here that would be incredibly efficient and would really outdo China in so many ways. I know Janet Yellen earlier was talking about having a global minimum tax for corporations. This is something I agree needs to happen, but this is a much better tax regime for the future, for the global economy, given the way it is. Also, would love to show you this book here. It's going to be backwards here. This is Crunch, written by Jerry Bernstein. Sorry, it's backwards. That is one of President Biden's top economic advisors. And about 10 years ago, I had a couple long meetings with him. And after we met about my tax plan, he gave me this book with that sign that we should move this tax plan forward. So again, if your inclination here is that this is a great, sorry, that it's backwards. But anyway, if your inclination here is that this is a great tax plan, it is. Smart minds think alike. And anyway, Jared loved this. So anyway, you may get an email from me with this video. And it will have my contact information on it. So if you want to contact me and talk further about these tax reforms, absolutely, please do. Please feel free to contact me, to call me or email me, and we can have a discussion at length, all you want, about these 3 tax reforms. And if you need any more detail, go to my website. You can find a lot more there, thirdwaveprogressives.org and qualityism.org. Or again, if you're on Capitol Hill, feel free to contact me, and I will spend all the time you want regarding these tax reforms or any other policies that I've worked on. And anyway, this is a time, it's a pivotal time in our history. It's a time that we need to set the stage for America being the leaders in this century, being the leaders of democracy in this century. This is a very, very important, crucial step here, this tax policy portion. So let's get this done. You know it needs to be done. So God bless you, and God bless America. And let's have a much more egalitarian and prosperous American economy in the 21st century.